How's it going, everybody? This is BeatTheBush. Today I'd like to talk about investing and how a lot of people like to say, oh, they're investing in something when they're really gambling. Now today I'm going to talk about the distinction between the two. I've heard of things like stock picking where people just take the newspaper, or these days online they just kind of cover their eyes and go, nah, I'm going to pick that one. And then it's kind of like playing the lottery because you don't know which stock is going to go up later on. There have been plenty of studies done where they analyze the hedge fund managers. These are professional people that they go in at work every single day and they look at stocks, they pick stocks, they have a large portfolio, and they're trying to beat the market. The majority, I think it was something like 80% of these hedge funds actually fail to beat the S&P 500 after 5 years or so. Now what does this mean? It means that if you just want to go in blind and not do any kind of research, you should be buying in an index instead. For example, you can buy the stock ticker symbol VOO, which is an S&P 500 index fund that has a low fee. If you manage to buy this fund and not get scared by the psychology of the stock market and just keep on buying, over the long term, yes, you will overperform these actively managed hedge funds. So when you go and buy an individual stock, it's kind of like an ego thing where you think you are better than all those hedge fund managers. Maybe you know more than they do somehow. Maybe you did more research. Maybe you have more insight or something. So that's what you're betting on. You're betting that you know better and that you can actually make a better return than those guys. I'm not saying this is bad either, because you gotta try to figure out if you are the next talented investor or not. If you don't try, then no one would ever find out. It's kind of like trying to be a basketball player or something, because if you don't try, yes, there's a very slim chance of being able to beat the market, but if you don't try, you'll never know if you can. With that put aside, I like to talk about valuation of an individual stock. When you go and buy an individual stock, it's kind of like when you're buying things for resale. When you look at it, you need to value the stock and figure out how much it's worth. Now that's a tricky business, and a lot of people will not tell you exactly how they do it, because that is the secret sauce. That is what makes them a lot of money. So when you buy an individual stock, it's going to be volatile. For example, it's going to go up and down like this. But perhaps the valuation is somewhere in between like this. And then whenever you see that the value of the stock is actually less than what you think the valuation of the stock is, then it's considered cheap. Then when you buy it, then you won't be afraid that it's gonna go down any further. So when it goes further down than the value of the stock that you think it is supposed to be at, then you should not be afraid of it going any further, because if it goes down any further, then you're just gonna buy it some more. Now that's a tricky thing to know, because when it goes down, are you confident enough that yes, you think your valuation is correct? Because you could be wrong, because there could be other factors that you didn't take into account. Maybe like there's some really bad news, some scandal or something about the company that just surfaced. So there could be risks there. Another thing to point out is not just the valuation of the company itself and this oscillating between, people really optimistic about the stock and sometimes really pessimistic. There are other macroeconomic factors that could make the price go up and down, even if the company is doing really well. So let's say you have a macroeconomic thing that goes up and down like this. It makes the whole market rise up. It's kind of like a huge tide of the ocean. But then your individual stock, it's just gonna go like this. If the whole stock market is going down, but your stock itself is doing well, it might not do so well as well, because it's just gonna keep on falling down. Now, what does all this have to do with gambling or not? Is because when you buy a stock, you better know a lot about the company, rather than just going, oh, I'm just gonna look at the stock, look at the price. It looks like it's really high right now, so let me not buy it. But what do you equate to it looks like it's high? Because a stock could go from $10 to $100 to $300, and it could still not be high, because maybe they made 300 times as much income. And thus, the price of the stock is valued correctly. It's not high at all. One thing that's a dead giveaway if you are gambling or not is if you know the background of the company. Do you know everything that they sell? Do you know their PE ratio? Do you know the price earnings ratio as compared to other companies within the same industry? I remember I made a whole bunch of mistakes investing. I've been investing for a really long time, and every single time I actually learned something new. And yes, I did lose money here and there, but then it's not much, because I was in the learning period and then I didn't have much income. And so the money that I lost wasn't all that big. The first thing I did when I started investing was that I just looked at some really low price valued stock and then go, oh yeah, that looks low. And then I read the news and then thinking that I know what's going on with the stock, but really I didn't. So every single day I checked the stock, it would be high or it would be low, but I did not know what was going on. Sometimes it would be up and then I had to go back and read the news after the fact and realize, oh yeah, it went up because this happened or that happened. That is an example of gambling because I had no idea what the company was actually worth based on their sales. The next pitfall is actually not knowing all the products that the company that you bought into sells. Sometimes when you buy into a company, they have more than one product. Sometimes they have a huge line of it. It's important to figure out their whole line of products because sometimes, let's say Microsoft or something, maybe they have their Xbox and everybody has an Xbox and it's really visible, but it's important to know how much portion of this Xbox is in their total income. So if the Xbox suddenly does really bad, let's say, oh my gosh, no one's gonna buy it and it goes down 50%, but if it's only 1% of that company's income, then it's not going to affect the whole company as a whole all that much because it's so insignificant. One thing that really causes a company's price to fluctuate, it's anticipated earnings, what people think they're going to earn. There's a certain track record that you can look at. It might be sort of in a high trajectory. They may not currently be making all that much right now, but maybe in the future they will. So people price this in, they think it's gonna go up higher. So that's why the price of the stock is gonna go up higher. And if it never satisfies this anticipation, then the price is gonna deviate from whatever people thought it was. So that's all I like to cover for today. I hope this makes you understand the difference between gambling and actually investing, because I know a lot of people would just open up a brokerage account. I see in the comments people asking me these days, oh, how do you invest, right? People are just gonna open up a brokerage account, Robinhood or whatever, and then they go and buy some stock. It's like stock picking. I think it's actually okay to do that if you know what you're doing. Know that you're trying to beat the market and know that you really need to research the company and really understand where the income sources are coming from, what the macroeconomic situation is for the whole company, and it goes on and on from there. You can read all the news about that company, but in the end, you still really don't know where it's gonna go. You can just kind of try to make an educated guess based on what you know. So I hope this helps you determine if you're actually gambling or investing. Don't forget to give me a like on this video, comment down below. Let me know if this helps you stop yourself from gambling, because that's the most important part. If you're interested in supporting this channel, I do have an Audible link down in the video description. I have in the past recommended the Intelligent Investor book, which is the same book that Warren Buffett recommends, and it's based on value investing, which is you try to buy the stock at a good value. You can actually get this book for free through my Audible link, and you actually at the same time help my channel out. It is a subscription plan, so if you don't like the service, you can actually cancel before the end of the month and you won't be charged a thing, and you can still keep the book. I also have a Patreon link over here, and don't forget to subscribe. Thanks for watching.